I do believe that prudent underwriting will dictate really the future IRR that we see on assets.
What would you say the number one secret is to underwriting multifamily properties in today's market? And what kind of resilience do people need to be practicing to make sure they're not catching a falling knife?
Absolutely. Great question. I think that's a question that so many economists, so many acquisition teams are going through. Rates right now are trying to understand where their values lie. So I do believe that prudent underwriting will dictate really the future IRR that we see on assets. So, having a really conservative exit cap rate, having conservative rent growth going forward, understanding controllable and non-controllable expenses much better. It's going to come over the next 2 years will come down to those groups that can have the experience in management and can adjust accordingly on their expenses and teams, and then really drive that customer service from an asset perspective. So I think those will be major indicators of who's successful and who's not.
I'm seeing the larger deals especially, right? And this has always kind of been true. And I call it the Amazon effect. Those that are vertically integrated with management, with local, contract services that go deep, relationships, of course with the broker relationships and, finding deals, underwriting deals, and really performance. But it seems like those that have, more units in a particular marketplace, they're more likely to be able to pay maybe a little bit more and or to be able to sustain changes that are going on, or at least do it in a more efficient way. So just talk about, Sequoia Equities and, guys, I think it's over 17,000 units, and how much that helps you guys to be able to weather the storms and buy deals and find deals and make them work.
Absolutely. Longevity in a marketplace is very important. Understanding the nuances associated in a changing market is very important. Economies of scale from a management perspective is very important. Having a team in place that has been, let's, for lack of a better term, they're very stable. They're very happy. We do annual corporate birthdays. So we just had somebody had 35 years with Sequoia Equities. So to say that longevity within a company is important at Sequoia from a cultural perspective, it's very important. And we find that happy employees tend to provide happy housing, happy tenants, provide customer service to tenants who are then happy, which then trickles down to the ability to have lower turnover. And then we have a savings and costs at the end of the day that just translates to great operating profit to the investors.
Absolutely. And that also probably means you can underwrite deals and you're understanding the deals and all the nuances because you have the data. It's direct data, right, in those markets. So what markets are you guys focused on now? Maybe talk about a recent acquisition or a deal that you're looking at now. What do you like about it? And maybe how has your underwriting even shifted, as far as an exit cap rate perspective? What kind of interest rates are you seeing on some of these quotes? And are you still buying?
Yeah, absolutely. Great question. So, we follow a lot of market dynamics. We use third-party sources. There's Reese, Yardi Matrix, Axiometrics, Moody's, et cetera, that compiles data. And we track that data to identify key markets that have great employment trends, that have great low new development trends. So we're not competing against high absorption markets. And we try to follow net migration in various markets. So as we look at those, we're hot on Denver. We're showing Seattle MSA is strong right now. It's from a jobs perspective. We see that there are some pockets in the Midwest and the Sun Belts that are very strong. And we're continuing to also, focus on areas where we already have management, but for picking off deals where there's significant value add that can occur in some of those markets too.